U.S. consumer spending surges amid rising service inflation, but what does it mean for the Fed's next move? U.S. consumer spending showed its strongest growth in 4 months this July, while inflation in the services sector heated up. Yet despite this robust demand, many economists remain unconvinced that the Federal Reserve will hold off on cutting interest rates next month, especially given the signs of a softening labor market. But here's where it gets controversial. Could strong consumer activity actually mask deeper economic challenges? According to the latest report from the Commerce Department released on Friday, the cost of services, particularly financial services, which have been influenced by a recent stock market rally, pushed the core personal consumption expenditures (PCE) price index to rise at its fastest annual pace in 5 months. This inflation measure excludes the often volatile food and energy prices, providing a clearer picture of underlying inflation trends. While tariffs on imports had only a mild impact on prices last month, economists warn that these duties are expected to drive inflation higher in the latter half of the year. The ripple effects don't stop there. As tariffs increase operating costs for businesses, companies may be forced to reduce their workforce, which in turn could dampen consumer spending. Already, many consumers are tightening their belts, cutting back on non-essential purchases and becoming more selective due to rising prices. Preston Caldwell, Morningstar's chief U.S. economist, sums it up. The data paints a picture of the U.S. economy slowly drifting towards stagflation, a troubling mix of stagnant growth and inflation. This puts the Fed in a tricky position. Despite this, we anticipate 2 rate cuts this year because the market has long priced them in, and recent labor market data is concerning. Consumer spending, which makes up over 2/3 of the U.S. economy, increased by 0.5% in July, following a 0.4% rise in June, aligning with economists' forecasts. The biggest driver was motor vehicle purchases, which helped push spending on durable goods up by 1.9%. Other areas seeing increased spending included recreational goods and vehicles, clothing and footwear, as well as home furnishings and durable household equipment. Food and beverage spending also rose, though spending on gasoline and other energy products declined. Overall, goods spending climbed 0.8% after a 0.3% gain in June. Services spending grew by 0.4%, matching June's increase, buoyed by financial services and insurance, healthcare, housing, and utilities. However, spending at restaurants, bars, and on hotel stays fell, a subtle but telling sign. Tim Quinlan, senior economist at Wells Fargo, explains, when consumers cut back on dining out and hotel bookings, it's not necessarily a disaster signal, but it does reflect the budgeting choices people make when feeling financial pressure. A persistently soft labor market will likely make consumers even more cautious about where they spend their money. On the employment front, businesses have slowed hiring, but have largely avoided mass layoffs. Over the past 3 months through July, job gains averaged 35,000 per month, a significant drop from the 123,000 monthly average during the same period last year. Wall Street reacted with a decline in stock prices, while the U.S. dollar remained steady against other currencies. Meanwhile, Treasury yields edged higher. Inventory drawdown and tariff impact, a delayed inflation effect. Federal Reserve Chair Jerome Powell recently hinted at a possible interest rate cut during the Fed's September 16 to 17 meeting, acknowledging growing risks in the labor market, but also emphasizing that inflation remains a concern. Since December, the Fed has maintained its benchmark overnight rate between 4.25% and 4.50%. Interestingly, the impact of import tariffs on inflation has been slow to materialize. Many businesses have been selling off inventories they built up before the tariffs took effect, and some have absorbed the increased costs themselves. However, inventories were drawn down in the second quarter, and companies have warned that tariffs are pushing up their expenses. Economists expect these higher costs will eventually be passed on to consumers. households are already bracing for more price increases. A separate University of Michigan survey revealed that consumers' one-year inflation expectations jumped to 4.8% in August, from 4.5% in July, with notable increases among independents and Republicans, including supporters of former President Donald Trump. For now, inflation remains moderate. The PCE price index rose 0.2% in July, following a 0.3% increase in June. Goods prices actually fell by 0.1%, largely due to a 1.7% drop in gasoline and other energy costs. Prices for recreational goods and vehicles declined by 0.9%, while furniture costs edged up slightly by 0.1%. Over the past year through July, the PCE price index increased by 2.6%, unchanged from June. When excluding food and energy, the core PCE price index rose 0.3% in July, matching June's gain. Service prices climbed 0.3%, the largest monthly increase since February, after 4 months of steady 0.2% rises. This was driven by a 1.2% jump in financial services and insurance costs, along with increases in housing and recreation services. Core PCE inflation rose 2.9% year-over-year in July, the biggest increase since February, and slightly up from June's 2.8%. The Federal Reserve closely monitors these PCE measures as part of its 2% inflation target. Scott Anderson, chief U.S. economist at BMO Capital Markets, warns, "We expect more unwelcome inflation driven by tariffs to emerge in the coming months." Trade deficit soars, potentially dragging on growth. While strong consumer spending bodes well for third-quarter economic growth, it also fuels imports, which could offset some of the gains in gross domestic product, GDP. A third Commerce Department report showed the goods trade deficit surged 22.1% to $103.6 billion in July, as imports jumped $18.6 billion to $281.5 billion, while exports slipped slightly by $0.1 billion to $178 billion. These wild swings in imports, largely influenced by tariffs, contributed to a GDP contraction in the first quarter. However, growth bounced back strongly at a 3.3% annualized rate in the April-June quarter. Conrad de Quadros, senior economic advisor at Brean Capital, notes, "On the surface, the trade data suggested drag on third-quarter GDP growth of about 3 percentage points. So what's the takeaway? The U.S. economy is showing signs of resilience with solid consumer spending and moderate inflation, but underlying pressures from tariffs, a cooling labor market, and a widening trade deficit paint a more complex picture. Is the Federal Reserve's anticipated rate cut the right move, or could it risk stoking inflation further? And how will consumers adapt if prices continue to rise and job growth slows? We'd love to hear your thoughts. Do you agree with the economists? Cautious optimism, or do you see storm clouds on the horizon? Share your perspective in the comments below.